morning. Football day, buddy. How you doing this morning?
It's good. I have the Monday Night Football theme in my head. Dun, 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 dun.
Yep, me too. I woke up with an extra step in my, or extra skip in my step. I've got the Sam Spence Spotify playlist loaded. I'm ready to go, boss. I'm ready. Just get me to the game. We've waited so long. We're almost there.
Put me in, coach. Let's do it.
Put me in. All right. First of all, thanks for joining us here today. I want to get right to it here. Let me get my note sheet up here. What are you seeing out there? Just kind of generally, what are you seeing out there in ETF land? Then I'm going to ask you some specific questions about some happenings in the market.
Yeah, sure. Everybody that's watching, it's no surprise. The U.S. markets are at record highs, at least the large cap and mega cap stocks. So what we've seen basically is a little bit of lighter flows in August in terms of inflows. We have seen mostly people looking to trade the bear side of a lot of these moves, looking for some level of retracement. And we've seen some profit taking in the bull products. You mentioned like gold miners, that's been ripping all year. So we're not surprised. We see a little bit of outflows in the bull funds for the most part, and inflows in the bear funds, especially when you get markets at these type of levels, people are taking profits. You're seeing from a non-leveraged standpoint, forget the tactical trading side, I'll take that hat off for a minute. Is this rotation real in terms of small cap? I heard your previous segment. That remains to be seen. I think the Fed meeting in September, I think it's baked in the cake already based on the Fed futures. The probability, you're basically talking 90+% of a cut in September. So they'll be looking at what the Fed says. And if the Fed says we might be one and done here, that might be it for the small cap rally. And you might see that rotation right back out. So it's interesting what we're seeing right now. Certain levels of the market, financials, for example, tech just off its all-time highs. So you're really seeing lofty levels for a lot of the markets here.
Okay, good stuff there. Look, I do have one question here. It comes from our audience. Frankly, we would not be able to have this show without the audience and without the audience's input. So I want to start with this because I asked a group of people, hey, what would you really like me to ask? And it seems that this is going to be the question here. So when you're talking about some of these ETFs here, whether it's for gold or for some of the individual names, the levered products, the unlevered products, et cetera, do you create these ETFs for the purpose of allowing investors to not sell and have to pay capital gains and instead hedge their long position with ETFs?
It's a good question. I think it's a multiple part question. First of all, our ETFs, and you've heard me on the show say this before, these are designed for short-term active traders. You got to monitor these on a day-to-day basis. They're not designed to be tax efficient. Now, with that said, if you want to hedge gains in an individual stock, for example, then you could possibly use our non-leveraged inverse ETFs, which is just inverse whatever the upside is for that given day of a given single stock or a broad index like the S&P 500. So those could be used, those tools, the inverse funds, to hedge potential long gains, especially in taxable accounts. However, if whatever hedge you want to maintain, you got to at least rebalance often to make sure you're maintaining that percentage hedge of whatever you want to be hedged on. So could they be utilized to at least protect gains? Yes. Do you need to monitor them day to day? Of course you do. And the higher the leverage point, the more tactical you have to be. So a 2 or 3x inverse product, a lot of people use those for more of an outright short, possibly for if they have a real short-term view and they want to express a bearish view. Those vehicles tend to be more for that. But a non-leverage or a 1x inverse, you can possibly hold longer. But you still need to monitor on a day-to-day basis to make sure you maintain that hedge. So long-winded answer, These are not designed to be tax efficient. They could be used as a hedge in certain cases, especially for taxable accounts that have embedded gains, but you still need to monitor these on a day-to-day basis. And a 2 or 3x inverse type of product, those are really short-term tactical trades.
It might be a long-winded answer, but it's a great one. And I think, just some context to how this question was generated. PLTD, which would be a really good example here. This is going to be the Direxion Bear 1X ETF for Palantir. The thought here is, well, gosh, there are people that own Palantir somewhat recently from like a 6 handle or some single-digit handle. Now you're looking at a stack that's $120, $150, and they're thinking to yourself, well, I can time this as a hedge, so maybe I'll use an ETF instead of booking some of those and then be on the hook for a sizable capital gains tax payment there. So really good stuff. We'll see how this shakes out. I know folks are doing this, and you're right about the being nimble there. It is the active investors that are thinking about this as a strategy. Anyone that's not active every single day, they don't really even seem to bring these up. So really good stuff there, Ed. Appreciate that.
Yeah, one more thing on Palantir. I just want, because it's a good example. In August, you had intra-month about a 20% pullback from peak to valley. Palantir really didn't have much of a move for the month, but intra-month there was tremendous volatility. So, like you said, for short-term tactical traders that could take advantage of that, PLTD might be something people would utilize. Also for an outright short, or like you said, to hedge some gains, especially for that swing period in August there where you had a significant decline.
Okay. All right. Let's ask about some individual things here. The big thing that's recent this week was the antitrust ruling for Google there. How did the antitrust ruling possibly impact Google and then the broader Mag 7?
Well, certainly good news for holders of Google on the long side. It popped to new all-time highs. I still would be a little cautious. I mean, valuation, Google looks good, but there's still AI competition with them, and I think there might be some concerns there. I think the biggest thing for some of the Mag 7 in general is that some of them might be deemed still monopolies. How does this affect other maybe potential DOJ monopoly antitrust suits? So it's definitely a win for Google, although it's different business lines and they may look at it differently. The courts could be a positive overall for the Mag 7, the broader Mag 7. Apple, which is also impacted by this because they're continuing to receive from Google payment for them using them as a default browser on their devices. So Apple popped also on the news by that court ruling as well, that they'll continue to receive those payments. Apple on a resistance level, I know you look at technicals, hitting right at that 238 area. If it could bust through towards 240, you might see higher prices. So there are ways you could play that, of course, off of headlines. We got the whole leverage and inverse single stock suite, 2x bull, inverse bear. On Apple, on the 2x bull, it's AAPU. On the bear, on the inverse 1x bear, it's AAPD. Of course, we have all the leverage inverse single stocks on the Mag 7. If you want to play it a la carte, if you want to play it collectively, we have an equal weight Mag 7. You can play the bull or bear on that too, 2x bull and non-leverage inverse bear on the Mag 7 collectively.
Okay, real good stuff there. I actually did trade Apple on that. Sometimes it's better to be lucky than good. I didn't know what that ruling was going to be, but we had a nice breakout there from 215 up to 230, and then the 240 level that you had talked about. All right, what impact has NVIDIA had post-earnings on the broader semi space? I know this is one of the leaders here this year. So what do you think on NVIDIA's post-earnings impact?
Well, I think based on their earnings, the numbers in forward guidance didn't have that wow factor associated with it. And NVIDIA is down about 6% since earnings. And of course, it's a bellwether for semis and AI. So semis sold off as well. For example, the SOXS, the non-leveraged semiconductor ETF was down about 4% over this period. I think there's renewed concern on AI and maybe an over-exuberance getting a little ahead of itself. You certainly have the continued uncertainty with tariffs and also government security concerns. And even NVIDIA themselves, during their forward guidance, had to withdraw pretty much the potential impact on China and take out revenue. So you don't know what the China impact is going to be on its revenue going forward. So there are a couple of concerns there. And NVIDIA also is still up strongly for the year. So this stock has been, lights out the last couple of years. So taking a little respite's no surprise. Broadcom earnings today. Stay tuned for that. That could be also something that might move the broader semi space. And of course, for those out there that trade our stuff on a short-term basis, our biggest fund is SOXL, triple leverage bull on the NYSE Semiconductor Index. And then on the bear side, we're seeing a lot of flows recently on the bear side, SOXS, which is a triple leverage bear on the semiconductors as well.
Yeah, I'll say just for me personally, I think the two most traded ETFs that I trade on a regular basis, SOXS and SOXL, those have been great vehicles for me, and I know a lot of our community here trades them as well. All right, before I brought you on here, we were just talking a little bit about gold, so you knew I was going to ask you about gold. How do you account for gold being at record highs in what seems like a risk-on environment?
Yeah, I'm a commodity guy. This is a little perplexing to me. I think there are a couple of reasons, most notably, when you look at physical gold, let's separate that from gold miners. We'll talk about that in a minute. Gold's hitting all-time highs in the case of where the equity markets are hitting all-time highs. So that is very unusual. But there are a couple of factors here why. One is gold right now is being used as maybe a dollar replacement because of the weakness of the dollar right now. Also, commodities tend to have an inverse relationship to the movement of the dollar. So a weak U.S. dollar tends to be favorable for commodities, particularly precious metals like gold and silver. You mentioned also. Yep. Is it 2011? I think highs. It hasn't hit that since 2011. It's interesting. Central bank buying. I saw a stat on this. Right now, collectively, global central bank buying. You're holding more gold. They're holding more gold right now than treasuries, U.S. treasuries, for the first time in 30 years. So that's really interesting. But
yeah,
also,
really quick, just to kind of cap that off, we talked about that earlier today too. According to the International Monetary Fund, gold now accounts for 15% of global central bank reserves. That was up from just 9% in 2022 prior to the Russia-Ukraine war.
Yeah, and I think it's, again, even despite the fact that the VIX is low, markets are at highs, there's still a lot of uncertainty out there. Look at right now, Trump administration within the courts, with who knows how tariffs are going to shake out. So there's a lot of uncertainty, of course. There's continued global conflict, unfortunately, throughout the world. So I think gold's looked at a safe haven, especially if they start cutting rates. This might be the preferred flight to safety, even more so. So adding fuel to the fire to the upside. But let's talk also. Gold's had drawdowns that have been pretty significant. So it's been a great trend, but also gold's had peak to valley declines of 50% plus. So, I want your viewers to be aware that it's been mostly smooth sailing so far this year. But again, you want to be cautious because when it does reverse, it is a commodity, could have a lot of volatility to it.
Yeah, absolutely. And that's really the $64,000 question, right? It looks like gold's breaking out. Gold's performance has been unbelievable this year. The question is, can we chase this performance, or is this maybe something we should have to wait out there? So really good stuff there. Now you focused on gold to start with here, but let's also talk about the miners. Why do you believe that gold mining stocks have outperformed physical gold this year?
Well, I think they're playing catch up. For those of you who've owned GDX, GDXJ, and these are non-leveraged versions of our products that are out there that are 2X bull and bear on the gold miners and junior gold miners. This is the first year from a calendar year perspective that they're outperforming physical gold since 2019. Now, during these type of periods where gold is rallying like this, you have the operating leverage that these mining companies utilize. They tend to outperform during these type of periods, gold miners relative to gold, but it's playing catch up for the most part. Keep in mind, I believe GDX or gold miners, the NYSE Gold Miner Index is basically at 2000 levels, and yet gold itself, physical gold, is at all-time highs. People love to trade our gold miners and junior gold mining stocks. Why is that? Higher beta than gold. They're great trading tools, both to the bull and bear side. And what's interesting this year is I wouldn't recommend people holding these for long periods of time. They got to look at it day to day. But the trend's been your friend this year when you look at gold miners. And for example, NUGT or JNUG are up more than 2 times what the underlying index is because of the compounding impact to the upside. Now, the flip side of it is the downside. You're down in excess of 75% if you've been trading the bear side for the balance of the year. So the trend's been your friend this year with gold miners and junior gold miners. It's up, I think, if I'm not mistaken, you can pull this up, right? I think GDX is up 90+% for the year, if I'm not mistaken, on a non-leveraged basis. So, tremendous moves this year in the miners.
I eyeballed it here, so my numbers are not exact, and I've got 94.5%. You are right on, hitting the nail right on the head there, Ed. Okay, with the recent Jackson Hole meeting and the PCE release, how are traders positioning themselves going into the Fed meeting later this month? That's all the talk here, right? September rate cuts. How are people positioning themselves?
Well, I think as you talked about before I got on this segment, Powell really tipped his hand at Jackson Hole. I think now at least 25 bips is baked in. The question is what the Fed says after, what their guidance is going to be in terms of whether or not it's a one and done situation. What's interesting is since the Powell speech, the 7 to 10 year Treasury, the 20+ year Treasury have been basically flat. So you really, for traders in this environment, there hasn't been much opportunity yet to take advantage of. But what we're seeing is inflows in anticipation of the Fed meeting in our TMF, which is one of our more popular products. It's basically triple leverage on TLT. It's a 20+ year Treasury. We also have the Bear TMV as well. And if somebody wanted to play the shorter end of the curve a little bit, 7 to 10 years, IEF people are familiar with. That's a non-leveraged ETF on the 7 to 10 year. We have a triple leverage bull and bear, TYD and TYO on that. But right now, jobs is a big focus. Yesterday, for example, you had July job openings fell more than expected. You had ADP this morning. I didn't see it because it was right before we got on. Tomorrow's non-farm payroll. So I think the Fed's going to continue to be focusing on economic data, being more data dependent in terms of what happens going forward after the September meeting. And the PCI, you can say what PCE rather, you can say what you want. Inflation is still sticky no matter what. So the Fed's a little bit in a quandary here. Maybe the job market's slowing down a little bit, but inflation is still elevated. And look at the beige book yesterday. You have consumer spending slowing. Why? Because you're starting to feel the effects, I think, of tariffs and the impact it has on rising costs.
Okay, real quickly, just to kind of complete the circle there, ADP non-farm employment change for August, 54 versus the 73 estimate, 54,000, versus 73 estimate. U.S. initial jobless claims, 237,000 versus the 230,000 estimate. Non-farm productivity for quarter over quarter for Q2, 3.3 versus the 2.8 estimate. And the continuing jobless claims, 1940 versus 1960. Prior read there was 1944. So there is your data. That did happen while we were on here, but we'll catch all of it. Do you believe that you know what? We actually had another question from the viewer. Let me get this in here before I forget. Brandy from our audience this morning is asking, Ryan, can you please ask what he would suggest for playing any gold or silver pullback? So the way I read that is we're not waiting to go long here. We're actually trying to capture alpha on the downside move. What would you recommend in this case?
On the downside move, well, we don't have the physical gold bear. So that's one thing. Some other competitors of ours you could look have that product for physical gold. But if you wanted to trade the gold mining stocks to the downside, or junior gold miners, which are just the smaller caps of the gold mining stocks, you could trade either DUST, aptly named DUST, or JDUST, JDST. Again, 2x bear, short-term trades. If you think a reversal's in order for gold miners or junior gold miners, And we're tracking indices that are tied to GDX and GDXJ, which are the non-leveraged versions of some of you might be familiar with, of gold miners and junior gold miners as well. So I would only look at these as short-term trades, certainly before they make any decisions on trading vehicles like leverage and inverse. You've heard me say this before. Go to our website. We got great education. Watch the videos. See if they're appropriate for you. You got to know the mechanisms of how these work.
Okay, producer, actually, if we could throw that link up on the screen or in the chat, that would be awesome. Really good call there, Ed. Thank you, Brandy, for the question. All right, do you believe small cap stocks can sustain their recent outperformance?
I think it's Fed dependent. If the Fed has forward guidance of more rate cuts, I think then small caps will continue the rally. You're starting to see a rotation with small caps. But we've seen this story before, and the ending hasn't been great. If you've rotated into small caps, you get these head fakes, so to speak. But the Russell 2000 is still 5% off its all-time highs. So I think there's room here for a breakout to new highs. But I think it's a lot based on what the Fed does with rates. And for your viewers out there, of course, the small caps are going to be a little more sensitive to interest rates, particularly when they move up, because they tend to need more funding, borrow more as a result of that. If they have debt and rates rise, that the cost to borrow could be greater for them, for example. One other interesting thing, the S&P 500, I saw this, lowest dividend yield in the S&P 500 since 2000 right now. I think it's about 1.2%. Another reason why I think you may see more of a rotation also, not that people are buying necessarily S&P 500 for yield, but it also makes the case that maybe this market's getting a little toppy in terms of the S&P 500 because, of course, how do you get your dividend yield? Of course, part of that is a result of prices. If your earnings can't keep up, of course, then at the end of the day, your yields are going to drop accordingly. So it's just interesting, that stat as well. Maybe it gives more impetus for also small caps to continue some of that momentum that they've garnered in August. We did see some significant outflows in our TNA, which is the 3X rather bull on the Russell 2000. And we saw some inflows, either a little bit short-term hedging or the fact that people don't feel from a short-term basis that the rally is sustainable in TZA, which are a triple leverage bear on the small caps.
Okay. Awesome. Speaking of flows there, where did you see the biggest flows in August?
Well, again, it was a little light in terms of inflows, but on the long side, where do we see inflows? With markets hitting highs, with a good month for small caps, with gold miners, we continue to see buying in some of the bear products in terms of SOXS, SPXS, which is the S&P triple leverage bear, continued buying in the bears in terms of gold miners. Like I mentioned, Dust and JDST, the junior gold miners bear funds as well. But we did see some bull buying or buying in some bull funds. PLTU, we talked about that before. We saw some inflows intra-month in August off the pullback in Palantir intra-month. And also Eli Lilly, ELIL. I don't know if your viewers, how much they follow Eli Lilly. Certainly a lot of volatility to it with the obesity drugs.
Yep.
They had some, at least initially, was interpreted as disappointing news on their obesity pill. So people were buying on the dip there, our 2X bull, with that single stock as well during the month of August. What's interesting is outflows were predominantly in bull funds for the month. And that's what you would expect. Hopefully people are taking profits, being short-term trading vehicles. And also you had financials at all-time highs, semiconductors and tech intra-month hit all-time highs in August. So you had a lot of things hitting all-time highs, not just 52-week highs in terms of August. So you had some selling on the news there with a lot of that.
Okay. Real quick here. This is from Tanya. You already touched on this, but I'm just wondering if we can maybe, as Tanya's asking here, explain it for dummies. real quick. Tanya's no dummy, and neither is anybody else. But nonetheless, here's the question. I trade the Direxion products, and I've been to the site, but I still don't understand the rebalancing and what can go wrong if you hold long term, and short term doesn't seem to be defined. Can you just briefly explain this?
Well, first of all, we have an education site within the broader website. It's a whole section dedicated to it. It's educational videos. One of the sections, and they're only 3 minutes each, they're about 6 parts to it, talks about the rebalance. So within the funds named is daily. Why is that? Because there's a daily reset of leverage. These are path-dependent vehicles. What does that mean in English? The trend's your friend. The longer it takes for something to trend in your direction, the likelihood is that you may lose money. So timing matters with these vehicles. And let me give you a quick example for Tanya and the rest of the viewers. Let's say let's keep it simple because I'm a simple guy. Let's say I invest $100 in a triple leverage bull fund. And the first day I'm lucky enough that underlying index is up 5%. So excluding fund fees and expenses, my $100 goes to $115. Why? The underlying index that I'm trading is up 5%. It's a 3X fund on the bull side. It goes to $115. But on day 2, unfortunately, that underlying index goes down 5%. So I lost 15% day 2. Most people would think that you're even after 2 days and back to 100. But because of compounding, I lost 15% on $115. What does that mean in English? I'm below $100 after 2 days. And I believe you're slightly below $98. So you're down after 2 days, yet the underlying index that triple leverage bull fund is tracking was up 5% the first day, down 5% the second. That's a simple 2-day example of compounding that viewers should be aware of. Now, the flip side is that same scenario. I invest $100, triple leverage bull fund. I'm fortunate enough that on the first day, that underlying index is up 5%. So I made 15% the first day, but on the second day this time, it was up another 5%, the underlying index. So that's where the compounding worked for you. It's because that on the second day, $115, I made another 15%. I'm over $130 after 2 days. So again, simple 2-day example. Up and down the same amount in terms of the underlying index. You're below your initial investment. Second scenario, the trend's your friend. It was up 2 days in a row. As a result of that, you were actually up more than 3x times the index over that 2-day period.
Okay, so that's awesome. I've actually tried to explain this a number of times in various different appearances, and I have not had an explanation that great. So that's perfect. Thank you very much there. Tanya, I hope that's helpful. All right, Ed. We got through a lot here. Today. Ed, this was absolutely fantastic. We got to give you back here before the holiday season. We'll update on what's going on in the finance, and maybe we'll take a look at the remaining NFL slate as well. Thanks very much for your time here this morning. That's Ed Egilinsky, Managing Director of Alternative Investments at Direxion.